Welcome back to the Owner Seat Podcast, the show for operators, franchisees, and founders who don't just want growth, they want clarity, credibility, and businesses that last. Before we get into it today, it's going to be a little bit different. I want you to know something about how I operate. I give, and if you didn't know this, give 99% of what I do away for free. I put out daily educational videos on LinkedIn. I drop 2 podcast episodes a week. I write, and if you haven't subscribed, please do, a Tuesday weekly newsletter, and I give away my free CFO Playbook for fitness and wellness owners for free. Go download it. My intent is simple. This is why I started Stratego, is to serve you, to make sure that you have support from a financial lens, because more businesses in this industry, in our fitness and wellness industry, need to thrive and survive, not get crushed by cash flow, bad decisions, expansions that break them. And yes, for the next 3 years, private equity is coming to our backyard, and I want to make sure that you are ready. The difference between running a business and running a business with a CFO level control is exactly what I'm trying to do for you all. And most owners don't need more revenue. We talk a lot about that, and we're married to the P&L. You need cash clarity, a decision grade system, a decision grade numbers system. And so if you don't know me, today I am the guest, so I get to spend time with you one-on-one. I'm Albert Ramos. I'm the fractional CFO for fitness, wellness, longevity, and franchise brands. If you're growing, expanding, or thinking about debt or private equity, your biggest risk isn't your passion, your ambition, your effort. It's operating blind. You don't have the visibility. Today, I'm going to break down exactly what I do, how it works, and walk through real case studies, real examples without the brand name. I want to protect that and be respectful, but you are going to get some real life examples today. So maybe you can relate with it. Maybe it's a brand similar to yours, or in a position that you're in today or will be in the future. So I'm looking forward to doing that. So who this for? This is for you, the franchisor, or maybe you out there that are franchisees, multi-unit owners, studio owners, and wellness operators. And for many of us, we've said this, you've said this at some point, or you're saying it today. We're profitable on the P&L, but cash seems to be always tight. We're just running out of cash. My checking account is just not there. I don't trust my numbers. My data's messy. Maybe you're doing the bookkeeping. I want to open locations. Albert, I have multiple licenses. I just don't know what to do and how much cash I need. I'm about to raise capital. Private equity is coming in. They're opening up the war chest. We know what 25 looks like. 2026 is even better, but I'm not ready for it. I don't have the financials, the data room, knowing that there's due diligence right around the corner. Or I need a CFO, but I'm not hiring a $250,000, $300,000 full-time executive. There's no way that my budget can handle that. And so I'm the person that you work with when you start saying some of these comments or you're in some of these scenarios. So I want to start with what Stratego isn't. Stratego, the name of my organization, my fractional CFO firm, is not just bookkeeping. A lot of people think that it is, that it's accounting. That's important, but we take it to the next level. I take it to the next level. And it's not just about Excel spreadsheets. Some of us like Google Sheets for the sake of spreadsheets. It's not just putting together a budget for you. That's simple and can be done, but it's not what this is about. This is strategic finance. What I built at Stratego is an actual finance operating system. It's giving you cash visibility, not monthly or 2 months down the road when it doesn't really matter anymore. It's weekly cash visibility. It's unit economics that you can defend, especially to a boardroom, private equity executive, or maybe just to your ownership team that you're talking to, or investors. Clean reporting is so important, not just KPI reporting, but think P&L and balance sheet and statement of cash flows and cash flow forecasting and your ramp and snow bridge. Talking to these private investors or private equity investors, banks, it's so important that you have the knowledge there. You have someone that can back you there. And finally, speed for decision cadence. And yes, I introduce automation and artificial intelligence, AI, within your finance back office so you can move fast. The world's moving fast. This industry As you see all throughout LinkedIn and all the posts, things are happening quick. It's evolving fast. The core deliverables that I'll give you that you should be aware of, or you can expect a 13-week cash flow forecast, a cash control system, so you can make decisions based off cash, not a P&L that comes, unfortunately for many of us, comes 20, 30, 45 days later, which is unacceptable. I'll come back to that. You're going to have monthly close discipline. So yes, we still do accounting. We do it fast. It's going to lead to a KPI dashboard again. So directionally, you, owner, executive, and field system unit, studio leader, general manager knows exactly what to go do. Unit economics, it's not just about the revenue, the dollar coming in. It's about how many times it's sliced when it gets down to the bottom line of net income or EBITDA. You need to know your yield play, and that requires a visibility of unit economics, including revenue per class, revenue per member. Some like to say average revenue per user, average revenue per member, your payroll percentage or margin, your contribution margin, your payback period. Many of us have CapEx schedules or want a CapEx schedule, deferred revenue schedule. I could go on and on. I love this stuff. Some of you want plans around build outs and expansion capital plan. How am I going to raise the money? How much money do I need to raise in order to get my license going and get another location open up? How do I get debt packages right? Albert, I need help. I've done this before and I've gotten a loan for 29 cents on the dollar in terms. I'm like, oh no, leverage my network. Banks are my best friend. We'll put together a debt package for you. Make sure that your lender ready and that your due diligence, I'm in there. So is my team around the covenant and terms. We're reviewing it. So we make sure we protect your cash and your business. Equity raiser support. A lot of people are asking me about this today, making sure that you're ready with not only diligence readiness, but your financial data room. It's so important. You might not even know what that is right now, and that's where we help you. And then finally, because of my background in operations, having worked with Lifetime Athletic, Public Entity, Gold's Gym, and 24-Hour Fitness, and then obviously many other brands at the fractional capacity, you're going to also get my operator lens. I've ran studios, I've ran clubs. So it's not just the finance ivory tower and the strategy. It is also being an operator, and I mix the two together in addition to tech. It's what to do next, not what just happened. And many of us, our finance back offices are just telling you what happened. Nowadays, you got to move fast. You got to go know what to go do very quickly. So first, I diagnose the truth. What's real? Let's talk about your state of the state and what's some of the distraction and the noise that we can scrape off of there. Then we build that operating system, that minimum system needed to make your decisions fast. Most owners, and you're probably spending a lot of time in your spreadsheets, you don't even need that many spreadsheets and reports. Sometimes I see up to 40 reports that you're looking at daily or throughout the week. It's just not needed. There's 5 numbers and a weekly rhythm that I focus on in the fitness and wellness industry. And we tie everything together, including cash, to those things. My job and our job at Stratego is to make your business financeable and scalable so you have options. That means an exit strategy or growth and expansion, or just loving what you do and doing it profitably so you continue to employ those that you're employing in the community, loving the ones that you're with, sure, and offering a great experience. So what I want to do next is walk through some similar case study that's probably very similar to what you're doing at your studio, club, or wellness clinic. So let me start with the first one. This example is a multi-location training brand, and they're scaling fast. Think unit economics and expansion. We got to make it work. So one client in this scenario is a multi-location strength training concept scaling aggressively. They've done a great job. Multiple units. This might be someone out there you can relate with this. Multiple openings a year. Things are rocking. I'm not saying it was smooth because we know what construction and opening, what that all looks like, but we're rocking. We're getting it going because the unit economics, there's some organic cash that it's feeding and funding. Beautiful. But now we want to take it to the next level. Your build outs were lean and repeatable. The model served as a very defined, has the demographic info. It's looking good. Really, the biggest win wasn't more marketing. You realize that it was about repeatable unit economics and discipline expansion. And what we decided to do as we came in here, because the opportunity was taking it to the next level, it was standardizing the per unit model. So we need to know what's going on. And that included CapEx, pre-opening costs, and your headcount or staffing ramp, understanding what it was going to take for that next level, building out a rollout plan, or I like to call it a ramp bridge, to make sure that we're not just blowing up cash and your cash gets tight, it runs out. Now we're dealing with landlord letters and emails. It's not a fun process. So you got to plan ahead of time. And then what we also did here was create a narrative for the bank, not only the pitch deck, but also a 13-week cash flow forecast, an actual financial data room for the bank. Once they allowed us to upload those documents, we did it within 10 minutes. I'm telling you, I get yeses from banks. They're my best friends because I move fast and we're prepped. Here's why these units work and why future units will work. Here's what they cost, and here's the payback. That's the difference between being expansion ready and it just feeling excited and like, oh, we got the funds, or we think we have the funds, and my gut feels great and I'm passionate about it. I'm emotional about it. There's differences there, and you want to play more in the mathematical precision and expansion readiness game versus I just feel great about it and I'm excited. It's expansion that's financeable. That's what I like to say a lot. It's financeable from the bank or investable from an investor, private equity group, or VC. So revenue is an opinion, I like to say. And you hear me talk about these in my videos. I love our training around the P&L. It's great. Yes, sales solves all. Revenue is amazing, but it's not the end all be all. And truly, the DNA of your business is cash. And so you need to know how to protect your cash and how to raise cash, OPM, other people's money. So that's case study number one. That might be some of you. Case study number two, some of us are actually pre-open. So you have a pre-open concept, or you're thinking about investing in a franchise. You're thinking CapEx. We're thinking working capital. We're thinking, how the heck am I going to raise? Is that an SBA, a traditional recurring line of credit, or LOC? Is that actual talking to angel investor, family offices, VC venture capitalists, or what have you, private equity? So in this example, I had another client that was pre-opening with a very specific CapEx number in mind that they had ironed out just with their experience, years of experience over time being in corporate America doing this, but also having some different examples in the franchise world. And they were working with a pretty good cushion around working capital. What they had to answer, though, was how much do we really need to raise? Right? What happens if the ramp is slower than planned? So many of us don't necessarily ask that second question. So what do I need to raise? I want to get that cash and let's roll. But what happens if that ramp period around sales, around your ancillary revenues, or even some of the profitability, maybe you got the yield math wrong. What if it doesn't happen according to plan? And this is where many owners that I meet with get crushed. And thankfully, many owners that reach out to me don't want that to happen to them. So we work through that. So again, it's how much do you need to raise? Yes, cash is king and queen. It's important. But what happens? What happens when the scenario is, well, things didn't go according to plan on revenue or costs, right? So budgeting out the build out is important, but forgetting the cash drain and not planning for it can get you in a lot of trouble. Think occupancy costs and rent. Payroll timing, think merchant deposits, think delays. That happens all the time. So what we did at Stratego for this client, this may be one of you out there that are in this position or potentially wanting to avoid something like this, you have to build the raise stack. And what I mean by that is CapEx schedules, contingency plans, but many of those that work with me, I call it scenario-based modeling. Scenarios, scenario A, what if this happens? What happens to cash and profitability? What if scenario B happens? What happens to cash and your profitability? It's so important to map all of these things out. So when it's happening live, you know which direction to go. You have something available for you. And so I do that with you. And that includes working capital as well. You also need to map out the ramp period so that cash doesn't fall off a cliff. The runway gets a lot of people in trouble, and then you're having to raise again. So it's so important that you understand what that ramp period looks like and what it's going to take. Then you have to structure the financing language. And this is where people don't have a lot of experience, is actually walking into a bank or getting onto a call with them virtually, or even pitching to an investor. You have to have the financial literacy and understand. It's like fishing with the right bait. I don't know if that's the right way to say it, but it's financing language that you need to know and being investor ready. And what I mean by that is you're talking about payback logic. You're talking about terms. You're talking about the narrative from a financial lens and letting them know what an investor or banker wants to hear, what they want to talk about. So if your model can't survive delays, there's something wrong. It's not a model. That's just you hoping and whipping something together. And that typically doesn't work. So that's scenario number 2. That's a great example of a client we've worked with. And that might be for someone listening or watching today as well. And we'd love to chat with you. Scenario 3, this one is one of my favorites because we see this a lot. The stalled project, needing funding. Things are at a halt and you're needing funding now. Things aren't going to progress. Maybe you're mid construction and things just happen, right? Maybe scenario 2 or case study number 2 is what occurred to you. Closing that capital gap, renegotiating with vendors and lenders and your landlord or property management or what have you, having a strategy in place to actually go have some very good and successful conversations. So another situation was a build project where funding was staged. Unfortunately, it stalled. There was multiple requisitions from the GC and landlord or what have you. There was definitely mapped out milestones. However, there was a bridge, there was a variance. Unfortunately, cash ran out. Although there was a baked in contingency, construction costs, materials, they just went through the roof at that time. So it's understanding, okay, what do you do next? You can't just say, well, let's bail. We got to figure out the solution. And that's working with landlords, that's working with GC, property development, and some others. And so what I do in the real world here is we want to quantify this gap precisely. So it's getting ahead so that we can close it for future so this doesn't happen again. Then it's proposing an option A, B, C, and sometimes even a D, but it's doing it again back to that financial language. It's also then creating a 13-week cash flow for the remainder of your build out. And I really suggest this for those that are looking to expand to. You want to understand what your cash runway is. And then you also want to protect your cash with the cash floor. Many don't even do that either. And so you can't go below the cash floor. And if you do, this is where you strategically get your revolving line of credit, many of you SBA loans or what have you. Then you coordinate the story, you connect the dots so that vendors and partners stay confident they're in the loop and you got your stuff buttoned up. So this was a great story. That's kind of a small example, or at least it sounds like one, but a major one. Imagine everything gets stalled and your baby is done. And we don't want that to happen. We want you to carry on and launch and open. So that's what I mean by cash control and not just forecasting. There's a time and a place for that. It's so important, but it's also making sure you have the tools equipped or the people around you that can help you make decisions under pressure. Because all of this can get very emotional, very stressful. Some of you are nodding right now. You know this. It can get very stressful during these build out times or pre-build out, pre-launch times. So I want to switch gears to case study number 4. This is exciting because we do a lot of work domestically, but also internationally. And many of you out there here in the States or down in South America or out in the UK and Europe or in Canada, you're dealing with portfolios that are multi-unit, but also multi-vertical wellness or fitness. And so profitability, pacing, knowing how quickly to expand, and then which verticals we're introducing or are going to continue to run with are so important. Those are strategic, not only operational decisions, but financial decisions. And so what I've done at Stratego and some of the clients that I brought on, we come from a place of advisory. So we're advising multi-vertical, multi-unit wellness and fitness operators domestically and internationally. And that means multiple business lines, which can get very complex, especially on the accounting side, not necessarily the forecasting side in your FP&A, strategic finance, but typically in the accounting side, it gets very chaotic and it can get very, very messy. Think multiple revenue streams, multiple entities, everything rolling up. Sometimes it just doesn't talk to each other. And so we come in and we make sure to modernize that so that you see things from a consolidated view, but also from a vertical and unit by unit point of view. So we had a group that was healthy, they're profitable, they're self-funding, it's organic, no need to raise anything from giving away their baby. Equity is what I mean by that, to get funds. They were doing this through actually bootstrapping and cash flowing themselves. But the strategic question was, how do we scale this? How do we continue this to dozens of units while also introducing new verticals in the longevity space or in the wellness space, in the recovery space. These are some of the strategic things you got to think about while also protecting your cash. So the work that I did there is you have to put structure around expansion pacing. You have to evaluate the ROI of any new vertical and make sure the pricing models there, you're thinking about volume price mix. You're thinking about all of these different things, again, scenario basing it as well, making sure that the core business is not falling asleep at the wheel while you're doing all these exciting things. Many of you out there that want to expand wellness, you got to understand what got you here is the core of your business. Do not let up on that. So it's important that you look at that and you also protect that moat as well. Cash is your engine. You have to protect your cash. Finally, building reporting structure, KPIs, and a financial back office reporting structure. So it shows in real time and week by week, not month or bi-monthly for some of us, showing how some of these new verticals are performing so that you know, is this we continue on and thrive, or is this an eject button? Let's get back to core. It didn't work out. So it's really important that you have that visibility. Scenario or example number 5, it's the fitness access platform scenario. And I'm really passionate about this. And we actually have a guest coming on next week from a company called Fitual. Look it up, do some pre-homework for me so that you really know what we're going to be chatting about. And for those that follow my posts, you understand that I'm already shouting it out loud because of the conversations that are happening today. The fitness and wellness membership model will be completely turned on its head very, very soon. So go look at my LinkedIn post. You'll know what I'm talking about. But I'm talking about that day pass, pay as you go model, partnerships, and how you monetize that. It's another case study here around how you develop a successful fitness access. Think the new wave of what a fitness club studio will look like, not a membership club, but the new access, dynamic pricing, usage-based club that's building the next version of what we're going to see in the fitness and wellness landscape. Hear me out here, the pay-per-use gym access. You think I'm crazy? Gym owners, get prepared. Yes, people are arguing with me and critiquing the thought process because it's going to completely flip the business model on gym owners. It will if you're not positioning yourself to be ready for this. It's going to happen, and this will be consumer and tech driven. It will be forced. It will be forced on our industry, and you have to be prepared that the 30-day way of what we've done for years and years will be completely changed, and it just makes sense. Consumers, us, don't want to spend 30 days of something we only use 8 days a month on average. And some of us, we get in there far more, right? We got some power users out there. But think about that. We only want to pay for what we use. You don't want to pay for the days you don't. And you might think that's ClassPass and that's, some of those others. This is completely different. I'm talking, this is the DNA, and it's priced and modeled so that you drive great revenue and also good yield and profitability. So the core wedge here is simple. Hear me out. We're helping gyms, studios, and wellness clinics monetize unused capacity with this pay-per-use type of model without the platform or your business taking massive profitability shrinkage. That's not the deal here. And so what we look at is the unit economics of this model and this platform. We also look at the marketing payback or your customer acquisition costs, the subscription revenue in a sense, and you can model it that way still, but it's not that 30-day membership. Your partner economics. This is going to be very collaborative. We've been saying this at HFA and Beyond Active, Connected Health and Fitness. You hear it on multiple podcasts out there. We want to work more together. There should be some more, not necessarily true consolidation, but if you're down the road and you're a different brand, let's work together. It's going to happen here. Growth strategy will be important here. And this is where we're helping out on making sure that your portfolio expansion is ready, your portfolio deals, and even having consistency amongst smaller portfolios, and then your messaging. And this is in partnership with many of our marketing partners out there on why the old forced model of this monthly membership that just has been around for the longest time is not going to be the model moving forward. Finally, there's our last example, and this is for all my franchisors and franchisees out there, the franchise platform, especially for you founders out there that are passionate about this, but you're really trying to take this to the next level. Make it a franchise or make sure you're expanding your franchise. That's capital raising, that's franchise readiness, and that's having that CFO infrastructure. You cannot get to that franchise level or expand your franchise without a finance back office and a finance executive. So I work with founders who are building franchise platforms or they have an existing franchise system, multiple concepts under that one umbrella too. So multiple brands as well. These operators, it might be some of you, you're operating or building infrastructure before even selling your licenses yet, before even selling a single franchise. That might be an example there. Or again, you're an existing franchise, but you want to take this to the next level. There's the legal aspects to it, and there's financial implications there. There's the design aspect, your space utilization efficiency. So the design of your franchise units is so important. Your vendor stack, your tech stack all have financial implications. And finally, what does your leadership team look like? So important. So what we do is we build that capital plan and capital stack and make sure that we have your cash flow, that burn rate front and center. It's so important for the survival. And then we're going to map out, even acknowledge and say what your use of funds are if you're capital raising, so that investors understand, what are you going to do with the dollars that I give you? Creating reporting so that we can make decisions fast, test, try, fail quickly, or succeed and move, so that you have early scaling and it just doesn't turn on into mass chaos. And finally, prepping your business to be diligence ready. I've had some guests on my podcast, some from Citron Cooperman, some from the FP&A world. Listen to what they say and what they look for. So really exciting for those that didn't work with Stratego before. They might have had messy accounting, messy books. Emotion was leading to expansion versus math. They had pricing models or the lack thereof of pricing models. It was just a very stressful environment because they were trying to do it all on their own without a finance leader. After working Strategos, the comments that I get is we have weekly cash visibility. We love the unit economics visibility by location, modality. That's important. Making sure we have a plan for build out and having a capital plan so that we can defend it, and then clean reporting so we have visibility to make decisions quickly and also be ready for those lenders, investors, and bankers. And then finally, a leadership rhythm, a weekly cadence where we're all chatting and everything is under the financial lens and umbrella. So I'm really excited. I know this is a bit of a change. I'm not as interesting as the guests that I have on the show. So keep watching. I hope you had an opportunity to get to this point, and hopefully there was a case study in there that you could relate with. Or if you know someone that you think it relates with, shoot this over to them. We'd really love to help, or refer someone that could help you as well. We have a large network, so many great people out there. I can name them all today. They're probably going to kill me for not, but if you follow my posts, you know who I like to promote out there. They're people of integrity and have been in the game for a long time, and they know their stuff. So if you're an operator out there, you're scaling fitness, wellness, or longevity, and you need that CFO lens, that CFO level clarity without hiring a full-time CFO, you know exactly what to do. Check me out at strategointel.com or just DM me and we could set up a call. We could chat through it. So excited. This is another episode of The Owner Seat. If you didn't know, and this is your first time tuning in, they drop every Monday and Friday at 8 a.m. And there's some great ones in the past too. So don't wait. Just go back. There's about 50 or 60 episodes now deep in there. There's some great stuff for everyone in the fitness, wellness, and owner seat. Thank you so much, and talk to you soon. See you all soon.